Hi, this is Mani from bsc2nse.com. So in this video we are going to talk about candlestick analysis and basics. Just very few basics and introduction, and I'll probably make more videos on candlestick analysis, and you can watch them. Subscribe to our YouTube channel to stay in touch so that you can be notified and you can watch the next series of videos as well. And I am an authorized person for Zerodha, and clients who are joining will get a free training on futures and options. So just to continue with this particular video, I've just made a set of agenda, and I'll be explaining with some of the candlestick graphs on Nifty and Bank Nifty and how to use them. So things to learn for people who are new to candlestick is that what is a body of a candlestick, what is the high, what is the low, and what is the close. So these are the very basics of judging a particular candle, and then how to identify a gap up or gap down, because a candlestick or a particular candlestick only represents the movement that happens during the intraday movement, or from morning 9:15 a.m. to evening 3:30 p.m. A candlestick does not, one candlestick at least does not represent what happens between one day and another day. To understand that, you need to understand how to, when you watch two nearby candles, you can understand whether it is a gap up or gap down, and you can understand that. So I'll also show you graphically how you can figure that out. And then I'm gonna talk about a doji pattern or a doji candlestick, and how to use a doji candlestick, and how to identify dojis in a particular candlestick graph, and how to use that to do simple trend analysis and an advanced trend analysis. So in the simple trend analysis, what we look to do is, I'll explain what is a doji and why and how that helps you in understanding a trend. So a doji is a candlestick wherein in that particular candle the open price and the close price is the same, or pretty much the same, or very close, and wherein the stick of the candle is pretty large but the open and close price or the body is very small. So that is a doji. And how a doji, you have to combine doji and the next two or three candles, or even one candle, to see which direction it takes and follow that particular trend. So basically, whenever a doji is getting formed, you will look to find what's going to happen next and take that particular trend. And an advanced trend analysis will involve looking at what has happened in the last few trading sessions, and then a bunch of dojis happen, and then what is the movement that is going to happen next. Okay, so let's move on to checking out some sample candlesticks that I've put up here. Okay, so the first two candles I've marked the highs, open, close and low. H is high, O is open, C is close, L is the low point. So this candlestick, I'm going to talk about mostly daily chart. So on a daily chart, each candlestick represents a movement that happens within a day. And if it's a 30-minute chart, each candlestick represents 30 minutes of the trading movement that happens. If you're looking at the 5-minute chart, we're looking at what is happening within 5 minutes. So the candlestick represents what is happening in a 5-minute period. Okay. So let's try and analyze this. So this period, where this thing where you see a straight line, I call this a stick, and then the shaded area or the thick area that you see is the body. Okay, so and if the shaded area is marked in dark or red, it's actually a negative candle, wherein in that period the market closes below the open price, meaning the market opened at a higher price here, went up in that period, and again went down, hit a low, and again closed at this zone. Okay, so this is a negative candle, and this is a positive candle, wherein in that time frame, let's say in the daily chart, this is the low point, It opened here, hit a low, and then buyers came in and pushed it higher, and hit a high, and then it closed here. Okay. So there are some more examples here. The candlestick can take any kind of a shape. So a doji. So let's look at because in this video I'm going to talk more about doji. And one thing you should remember is there are too many patterns, too many kinds of patterns in candlestick analysis, and not all of them are useful. So you should probably pick only few which are very strong indicators. And let me mark the dojis out here. Okay. So among all these candlesticks, this is a doji. I'm gonna mark a bigger circle. This is also a doji. I define doji as a candlestick where the body of the candlestick is very small compared to the entire length of the candle. Okay. For example, here the body represents almost 80-90% of the entire length of the candle. So this is not a doji for me. This is actually a strong buy candle wherein buyers have won and pushed the markets higher. This is a candlestick wherein the body represents almost 25% of the entire candle, and this is a negative candle wherein the sellers won. Okay, but I wouldn't call this a doji. For doji, I would say the body should be less than 15% of the entire candlestick length. Okay, so this is not a doji for me. This is a strong negative signal, or a negative I would say a negative tick. So on this day it opened on the close to the higher side, and it hit a low, and then markets closed on near the low point, right? So this is a strong negative tick. This is a positive tick, but not a strong positive tick. It hits a high, and then it closes somewhere in the middle of the entire day. And if you look at it, the body forms almost 50% of the entire length. So only these two candlesticks are dojis in this entire set of candles. There are 1, 2, 3, 4, 5, 6, 7. Out of these 7 candlesticks, only these two are dojis. So let's try and understand what a doji is. A doji is a candle wherein the body represents only 20% of the entire length. And here you can see it opened here, and then it closed pretty much the same price. In this candle you can see that it went down completely, and then buyers again came in and pushed it higher again, and the markets closed pretty close to the same place where it opened. And again here you can see there's only a flat line, meaning markets opened and closed at the same point. It opened at a value, went down, went up, and then closed at the same price, meaning neither the buyers won, neither the sellers won. So it was a neutral day, or like an extreme neutral day with huge positive and negative fluctuations. So it is an indecisive movement wherein the markets did not pick a direction, or it was an entirely directionless day, or you can look at it as a case wherein markets are still waiting for further confirmation on which way it should go. So I'm gonna show you, like this is the Nifty chart. Okay, so now I'm going to show you how to identify gap ups and gap downs. You've now learned to identify how to identify a doji. Okay, and I later tell how to use dojis to find out a trend. So this is like a bunch of candles. This is the actual Nifty chart for the last 3 months, and I've actually enlarged it so that you can see it properly. Okay, so here you can see that you can identify gap ups and gap downs. For example, you can see this candlestick here, right? And then this candlestick, the next day it's a strong gap up, meaning today, let's say this was December 9th. December 9th, the market closes here. And if you look to the right, it is actually close to 6250. The market Nifty closes at 6250, but the next day it opens gap up at 6350, gap up by 100 points, it actually opens here 6420, gap up at 100 points, and then through the day it falls and it closes at 6350. Though this is a negative candlestick in the day, but overall if you see, it is actually upside movement between the days. So this is how you should learn to understand how to identify gap ups and gap downs between two candles, right? So if you look at it, this is if you compare this day and the next day, it opens gap down actually, and then again it opens gap down, and then again it opens gap down, and again a gap down. So again here it kind of neutralizes, right? So I'll now talk about identifying dojis in the chart and how to use a doji. Okay. So I'll only mark dojis in the chart. This is not a doji. The body forms more than 50%, here 50%, 90%. This is also like 60-70%. This, the body is only like 20%, and this again is a doji wherein body is like not even 5% of the entire stick, right? Or I'll use like thicker lines. Okay, so this is a doji, and this again is a doji. Okay, so basically when the dojis are getting formed, you will look for what is happening in the next day, correct? So here we have a doji. The next day we have another doji, but it is a gap up opening, which means you take the trend after a doji is getting formed. So here a doji is formed. The next day the markets opens higher. So as a trader, you see that it has in the last 5 trading sessions, markets has actually fallen down, and this you can take as a recovery signal or like a strong buy signal. Wherein a doji, if the first doji is formed, the next day markets opens gap up, and again this day happens to be a doji. So here buyers, here the market traders are like not decisive. They don't know which way to go. But the next day you have a strong gap up, which tells you that there is strong enthusiasm among buyers. But still the day ends up as a neutral day, and then the next day again you have a strong uptick. You can see a hollow candlestick. So you can, this is a strong buy signal. You could have gone long here, and then you have a doji again here, meaning an indecision. The next day it moves up here, and then a doji, and then it takes a little profit booking, and then it finally moves up. Okay, and then you can see that here starting here you can actually combine candlestick with other indicators like Bollinger Band and RSI to identify the tops and bottoms. And here you have another doji, and already there is a downtrend here, and here you have a doji. The next day it's opening strongly on the gap down. Okay, so as an intelligent trader, you could have gone short even on this day. You go short here. I'll mark like a red line so that an intelligent trader could have gone short here in this candlestick. An intelligent trader would have gone long here, somewhere here on the third day, wherein you had 2 dojis and the third day is a strong uptick. Or you could have even gone long here, right? So these 2 dojis represent a strong upside movement, and this doji, you have a doji followed by a strong downside, and this you could have entered into a fresh short. And again, let's look for the next doji. Your target, of course, in this case, you could have found out the bottom by using either RSI or Bollinger Band. If you looked at it, this may have been towards the lower Bollinger Band. And here you see the markets consolidating here in this zone, wherein the downside has stopped, and you have an uptick here. So somewhere here you could have put the stop loss, and you could have covered your short. And similarly here, Here you have a doji. If you had entered into a long position here, as soon as you see in the next doji, you could have had a stop loss. You could have even exited here, right? And then let's watch for further dojis. You have one more doji here, and the next day is a strong uptick, of course, and you have one more doji here, and this uptrend does not actually pick up. You have a doji followed by a upside movement or a gap up, which tells you an uptick. You could have even entered long here, and the next day, of course, you would have probably had to exit at a no loss, no profit, no loss, no gain situation. And you have one more doji getting formed here, and then the next day is a strong downtick, you can see. So you could have actually gone short here, entered into a fresh short. So I'm going to mark a red line somewhere in the middle here, right? Or even at the end of the day here, you could have entered into a short in this zone. And then you have the next doji getting formed here. I'm going to mark it in black. So here you could have actually covered the short that you went here, and you have a doji here, one more doji here getting formed, followed by a strong uptick. So two dojis getting formed. Even this is pretty much a doji, but like 20%, 30% of the entire stick. But this is a strong doji, and then followed by a strong uptick, a gap up opening, and then a strong uptick. So I'm going to move to the right here, and I'm going to mark a green line somewhere here. You could have entered into long position somewhere here in the next 1 or 2 days. Even after the next day here, you could have entered into a long position, and you could have had somewhere a stop loss like here or here, right? And then you see markets going up, coming down, going up, and then you have the next doji here. So this you can also like pretty much call like doji to doji trading, wherein you take one doji to enter, the next doji to cover positions. So if you had entered long here, you could have booked the profits here, and then you have a doji, and then followed by couple of days of uptick, and then there's a downtick, and then there's a strong down movement, gap down. So pretty much this movement you probably could not have made use of because there was no doji, and a doji followed by a strong downside here, even though it was not, the immediate two were positive. After that you have two consecutively strong negative days. So these are not clear signals actually, they're still signals though. And then you have a doji here, a big doji here, and the next day again markets moves up, and then a strong down tick, negative tick again, and the next day is a strong negative opening with again couple of dojis here, couple more dojis on the negative side. This is a was an excellent shot because you had a doji here followed by a negative tick followed by a gap down. So you could have like gone short anywhere here. Even though this is not like a strong signal, this is still pretty much a signal for me to go short. You could have gone short here, and you have next few dojis coming up wherein you can see some buying happening. I would still mark the next doji, next couple of dojis here. This is a doji, even the one to the left of this doji is pretty much like a doji. So if you had went short here, you could have covered your positions here. And after this doji, you can see that the next day is a gap up opening. Even though it's a negative candle, it's opening gap up, and you have further some more dojis followed by strong upticks. So in this uptick, probably once you have a doji, and then you watch the what's happening with the markets in the next couple of days, you could have probably gone short because there is a doji and then a strong downtick. If you had gone short, you again cover that short with minimal losses, wherein you see couple of strong upticks here, and then you go and after this doji here, this is resistance zone is cleared with the strong uptick here, So if you had gone short here, somewhere here, then you see this as the resistance zone, the upper side of the doji stick, which has been cleared here. So you booked these losses, you entered short here, hold for a couple of days, the market has moved up, so 50 points in losses, and you enter into a fresh long here because you have a doji here, you went short, and for some reason the buyers have come in and they push the markets above the doji resistance. So here you again enter into a fresh short, book losses in the short position, enter into a long position here and hold for the next few days. Okay, so this is Nifty, and let's now look at Bank Nifty. I'll show you the Bank Nifty chart, and similarly we look to identify. This is the Bank Nifty chart, and I look to identify the dojis here and identify which way you could have actually gone. Right, so this is, even though this is like a 20% doji stick, this is not exactly a doji for me. This is a good doji, so let's mark the dojis. This is a doji followed by a strong uptick, a strong gap up opening on the next day, right? So you could have gone long somewhere here, wherein on the same day or the next day wherein you get some little downside, you could have gone long here. And then once it goes up, you can see the negative candle here, and the next day also is negative. So somewhere you could have used the stop loss to exit. So basically you go long here because you have a doji and then followed by a strong gap up and an uptick. Even if you look at this as a doji, I'm gonna mark it in black. This as a doji, you have a negative candle, but it closes pretty much at the same spot, and then couple of upticks here which crosses the doji level, and this itself is a decent uptick from the doji. So this followed doji followed by a trend. You can take that trend and you have one more doji and you have one more uptick here. Okay, so the next doji gets formed somewhere here, right? So I'll definitely take this as a doji. Yeah, this is a doji, and the next day is a negative tick, so you go short here. And of course you will have, like I said in the Nifty, in the at the end we had a fall signal. Of course you will have fall signals. You should be quick to book losses and enter into a fresh position again. So you enter short here, and then you have one more doji wherein people are markets are moving down and people are thinking about covering their profits, and the next day is a strong negative tick and then a positive and then a strong negative tick again. So somewhere here, somewhere in this zone, you will actually look to book profits or wait for the next doji. Where do we get the next doji? There's no next dojis. It's all strong, either up move or downside move. So you have the next doji here. So whatever you went short, you could have actually booked profits here. But then book profits here, and the next day again is a strong negative tick. So you can enter into a fresh short again somewhere here, right? Or even here in this zone in the next 2 days, right? And again you have a doji, the next doji you have here. So a lot of people confuse and talk about like shooting stars, hammer, inverted hammer, hanging man, and they complicate candlestick analysis. But this is a doji and then followed by couple of strong negative ticks. So again you could have went short here and covered somewhere here, and again you can see that markets are like bottoming out and again coming back up, right? So we will watch for the next opportunity wherein this is a doji, even the candlestick before that is a doji, right? A doji formed by a strong gap down, the next candle is a strong gap down. So this is again a fresh short entry, good short entry. I'm gonna mark that in red, right? Here you could have gone short, and then again we will look to watch for the next doji whenever The traders are indecisive. Again, at the right side end of the chart, you can see the bank nifty values: 9,500, 10,000, 10,500, 11,000, 11,500, 12,000. So the next doji appears here, and this is a pretty big doji, and then followed by a negative tick. It goes up, it's not able to sustain, it goes down again, and the market closes below the close of the previous day. Again, a decent sell signal here. You can see a sell signal here at the end of the day. Markets again tanks on the downside. It gets pushed lower, and then you can see pretty much a doji here, one more doji here, bunch of dojis getting formed, one more doji in this zone wherein markets are consolidating. It's neither moving down, neither moving up. Traders are not able to pick directions, or eventually the net market movers are not able to pick directions. They're still waiting for a strong uptick or a downtick, right? And here followed by a bunch of dojis, 1 2 3 4, you have a strong uptick. So here is a strong reason wherein you just go long here, take a fresh long entry here, and then hold for the next few days. And this video, the date is February 19th 2014. So the last signal that you have in the end of the chart is you have a strong uptick, and you enter long and hold for the next 5 to 10 trading sessions and wait for the next doji. You can probably book profits when you see a next doji, and then see how again the trend changes. So basically you wait for watching the dojis, and then whenever a doji occurs, you take the immediate trend that follows and watch for the next doji, again book profits and wait for a clear direction from the markets. Okay, so any questions, any queries, post on this video or log on to my forum, and you can post your queries there. And like I said before, clients who are joining Zerodha through bse2nse.com, I'll be providing a free training session on futures and options trading strategies. Thank you. Bye bye.